Hello everyone, welcome to today's lecture video. Today we will be covering Chapter 8, which is titled Stock Valuation. So in this chapter, what we will first start off doing is describing some of the different methods on valuing shares of stock, particularly focusing on dividends and stock values and the connection between the two. We will then discuss important features of common stock versus preferred stock, and then we will discuss how shares are traded and reported in the financial press. So our learning objectives here today: first, explain how stock prices depend on future dividends and dividend growth. Then we will show how to value stocks using multiples, just another method that is used to value a share of stock. And as you will notice throughout today's discussion, when I say value a share of stock, I'm simply trying to identify what would be the price at that particular point in time. Then we will lay out the different ways that corporate directors are elected to office. And then lastly, we will define how the stock market works. So starting off, why are stock valuation formulas important? So when stock prices rise or fall, how do investors or the financial managers of these companies know when it is time to buy or sell? So you may want to know if the firm's stock is undervalued or overvalued, and how can you tell if a stock's value is overvalued or undervalued? Well, keep in mind that the overall goal of a company is to maximize the current value of the firm's stock, so maximize shareholders' wealth. And so what we will be doing today is trying to identify what are some of the different components that go into these different valuations of the shares of stock. So as I just mentioned, the overall goal of the company is to maximize the current value of the firm's stock, which is increasing stockholder value. So common stock valuation, what we'll focus on first is common stock valuation. And we'll discuss what the difference is between common stock and preferred stock here later on in today's discussion. So a share of common stock is more difficult to value than a bond, what we did in the last chapter, those debt obligations of corporations and governments. And this valuation of common stock is more difficult for three main reasons. First, the promised cash flows are unknown. So we'll talk about what the cash flows are, but with bonds, it was simply your coupon payments and the face value amounts. Typically, those were set at the time the bond was issued. With stock, it's not as certain. So the future cash flows being dividends or selling your share of stock, these cash flows are unknown. Two, the life of the investment is essentially forever. So with bonds, you had a finite time frame. With stocks, they do not have a lifespan. So they are essentially forever since they do not have any maturity dates. And then three, there is no way to easily observe the rate of return that the market requires. That rate of return then would be your discount rate when you are valuing these future cash flows. So if you own shares of stock in a company, you can receive cash flows in one of two ways. The first way would be receiving a dividend. So if you think back to Chapter 2, after a company goes through all of their expenses, they get down to their bottom line, their net income. So with their net income, a company has two options. They can either pay it out in the form of dividends or add it back to the company in the form of retained earnings. So as a dividend, that would be a cash flow that you could receive as a shareholder. The other way that an investor that has purchased a share in a company could receive a cash flow is actually selling their share. So if you choose to sell your share either to another investor in the market or back to the company, that would be the second type of cash flow. So as with bonds, the price of this stock is the present value of these expected cash flows. So as you value things, you'll find out that the value is simply the present value of these future expected cash flows. With bonds, it was your interest, your coupon payments, and your face value, the principal amount. With stocks, it's a little bit different. It is either the dividends or selling your share of stock. Well, those dividends are your cash income, so those are your periodic income throughout the investment horizon. And then the selling of your share of stock is what is called a capital gain. So if the value of your stock increases from the beginning time period to the end, you would experience a capital gain, or you could also have a capital loss in the event that your cash flow actually decreases. So as we value these shares or price these shares, the price is simply the present value of these future cash flows. So that leads us to our first equation. The first equation says that our price at time zero, that's what that subnotation zero represents, that our price at time zero, current price, is the present value of each dividend, the dividend from time period 1, time period 2, time period 3, all the way until infinity. Take all of these cash flows and discount them back. That's your discount rate. 1 plus R is your discount rate, and we discounted back the appropriate number of periods. We did this in Time Value of Money, chapter 5. But our current price is simply equal to the sum of the present value of all of these different dividends. This model this first model for valuing a share of cash flows simply says that a stock's value is the present value of the expected dividends. This model is called the general dividend valuation model. So the general dividend valuation model simply states that the price of a share of stock is equal to the present value of all the future dividends. Now, as you can imagine, it would become very difficult to figure out what all the future dividends are, right? So how can we actually make an estimate for an infinite number of future dividend payments? So what we are going to do is we are going to begin by making assumptions on what is going to happen to the dividends in the future. So if we cannot identify any of these three assumptions, the valuation method that you would use is the general dividend valuation model. Simply figure out what the dividends are and discount them back to a present value. Otherwise, what we would like to do is we would like to make some type of estimation or some type of assumption on what's going to happen to the dividends. The first assumption is that the dividends remain constant, which is called a zero growth assumption. So whenever there is a zero growth assumption, whatever the dividend amount is, it's going to stay that amount forever. So the firm will pay a constant dividend forever. For example, let's say the dividend is expected to be $1. The future dividends for the foreseeable future will just simply be $1. This is how a preferred stock typically works. So with preferred stock, they have a fixed dividend amount, and that does not change. The price then of a zero growth stock is computed using the perpetuity formula that we discussed in the last chapter. A constant cash flow equally spaced for an infinite time frame. That's the definition of a perpetuity. Now we'll go through examples of all these different assumptions here in the upcoming slides. The second growth assumption is that there is constant dividend growth. So the dividends are going to grow at a constant growth rate. So the firm will increase the dividend by a constant percent every year, say for example 5%. So let's say the company says that they will increase their dividend by 5% per year, and they plan on doing so for the foreseeable future. And then the third growth assumption is non-constant or supernormal growth. So with non-constant or supernormal growth, the dividend growth is not consistent initially, so it's sporadic or it has some non-constant growth, but then it will eventually settle down to a constant growth. So what we will do is we will combine the previous model of the general dividend valuation model with the constant growth model in our valuation. So as I mentioned, we will be going through each of these different scenarios here on the following slides, but these are the three assumptions that you make on dividends. So if you can't make any of these three assumptions, you would use the previous equation, which was your general dividend valuation model. Otherwise, we will use one of these three assumptions. So first off is zero growth. So zero growth is basically a perpetuity with a constant cash flow. So if you think back how to value a perpetuity is simply valued by taking the constant cash flow, which in this case is the dividend, and you divide it by your required rate of return. So this is not a new equation for us. We've already covered how to value a perpetuity. We have just simply restated the variable as a dividend as opposed to just a constant cash flow, since this is the dividend or the constant cash flow that you would receive. So let's take a look at an example. So the current stock price of Largent Incorporated is $44.72. So this $44.72 is your P sub 0. That's the current price. The required rate of return is 19%. What is the dividend paid by this firm, which is not expected to grow in the near future? So that is telling us right there that we have a zero growth assumption. So to solve for the current value, we would use our constant growth or our zero growth equation, which says that the current price is equal to the constant dividend divided by your required rate. So in this case, our current price is $44.72. The dividend is what we are solving for, and our required return is input as a decimal, so we input 0.19, and we can see that the constant dividend would end up being $8.50. So that is our answer, $8.50 on this zero growth assumption. Take a look at another example. So now let's say that the stock is expected to pay a 50-cent dividend every quarter, and the required return is 10% with quarterly compounding. So this 10% is an annual rate, and it's compounded quarterly, so we would have to make that adjustment in our equation. They want to know then what is the price. So once again, they are paying 50 cents dividend every quarter, and it doesn't say anything about that dividend fluctuating. So what we have is zero growth, which we treat as a perpetuity, but now all of these need to be input in on a quarterly basis. So P sub 0 is equal to that 50-cent dividend, but then the quarterly rate would be 0.1 divided by 4, or we would find out that it would be 2.5% per quarter. So our current price then would be $20 on this zero growth stock. Okay, so that is a zero growth assumption. Hopefully the valuations here seem relatively straightforward since we've already valued perpetuities, but it is simply the price or the present value of the expected future cash flows is equal to that constant cash flow, which is the dividend, divided by your required rate of return. So as I mentioned previously, preferred stock usually has a constant dividend amount, some percentage of par value. So as we go into our discussion later on the differences between common stock and preferred stock, realize that preferred stock is our zero growth assumption. Let's take a look at another example. So here Hollywood Corporation pays a constant $8 dividend on its stock. So what we have is zero growth. It is a constant cash flow. And the company will maintain this dividend for the next 5 years, and then it will cease paying dividends forever. If the required rate of return on this stock is 12%, what is the current share price? So, one thing that we need to emphasize is that on our three previous assumptions, zero growth, constant growth, and non-constant growth, those are assumptions forever. So those are assumptions on what will happen to the dividends for the foreseeable future, no finite time frame. In this case, these cash flows are only occurring for the next 5 years, and then they are ceasing paying dividends forever. So we only have 5 years of cash flows here, and so we cannot apply one of our previous growth assumptions. What we will have to do here is use the general dividend valuation model, which states that the present value or the price of a share of stock is the present value of the expected future cash flows. So what we have here is simply 5 years of cash flows, and these cash flows being $8 per year, and the price then would be the present value of these 5 years of cash flows, and we will be discounting them back at a 12% discount rate. Now, you could do this a couple different ways. You could do each individual cash flow, discounting the first dividend 1 period, the second dividend 2 periods, 3 periods for the third dividend, and so forth. Or you could use your net present value function that we talked about when valuing multiple cash flows. Or, if you've noticed here, this is simply an annuity for 5 years where we have a constant cash flow equally spaced for a finite period of time. So what we could do is simply solve this one very similar to how we did our annuities, where we are solving for the present value. We do not have an extra cash flow at the end of the 5-year period. 5 is our end, payment is $8, and the discount rate is our required rate of return, which is 12%. When we solve for the present value, the price of this share of stock is $28.84. Now, the main purpose here of this particular problem is to understand that our growth assumptions are growth assumptions that we're making on cash flows that occur forever. So with this one, the cash flow stopped. So what we would do is use the general dividend valuation model, which is a model that you use when the dividends are ceasing after some time period, or if the dividends do not exhibit one of the 3 growth assumptions that we have introduced on a previous slide. So the first growth assumption that we have covered was the zero growth. The next growth assumption that we will cover is constant growth. So I actually started solving this problem before this bullet came out. Can you apply the zero growth assumption to this problem? Why or why not? Hopefully you realize that we cannot, because the cash flows are not going on forever. It's not a constant cash flow forever. It's a constant cash flow for only a finite period of time. So the second model is constant growth. So with constant growth, this is an appropriate assumption for mature companies with a history of stable growth. And with this, the dividends will grow at some average growth rate from one period to the next, and they will do so forever. Okay, so this can be a positive or a negative growth rate. And before we can calculate or before we introduce the equation or the method for solving for a constant growth problem, we first need to be able to compute the value of any dividend payment for any point in time. Now, if it's constant growth, this is simply solving for the future value of a cash flow that we know today. So your equation would say that if we know the dividend for time period 0, so the dividend just paid, then we could calculate the next year's dividend, D1, by taking that dividend and multiplying it by 1 plus the growth rate to the first power. So this is the same thing as what we did in Chapter 5, Time Value of Money, that said that future value is equal to the present value multiplied by 1 plus r to the t power. We've just introduced, instead of present value, we know that we use the cash flow that we know, which is the current dividend, and our r is our growth rate, our constant growth rate. So now I can find any dividend, d sub t, by simply taking the dividend I know, multiplying it by 1 plus the growth rate raised to the number of compounding periods that I need to compound. So as I mentioned, d sub 0 is the dividend just paid, so it's a cash flow in the past, and then d1 would be the next year's dividend or the next dividend, and all the way to d sub t would be your expected dividends. So now that we can calculate a dividend for any time period, we can develop what is called the constant growth dividend model. The constant growth dividend model is also called the Gordon growth model. So it does go by different names. It's also called the dividend discount model, but there's a couple different names that you can have for this constant growth assumption. So your equation for constant growth, let me erase this part since I kind of overlapped here. Your equation for constant growth says your current price, P sub 0, is equal to the next year's dividend divided by R minus G. And that's very important that we realize that when we are calculating the current price, I need the dividend for the first year, which I divide by R, my required rate of return, minus my constant growth rate. So let's take a look at an example. I'll highlight some of the important features here. Merriweather Manufacturing Company has been growing at a rate of 6% for the past 2 years, and the company's CEO expects the company to continue to grow at this rate for the next several years. So what this tells us is that we have a constant growth assumption. We are assuming constant growth in our dividends for the foreseeable future. Now the company paid a $1.20 dividend. Key part right here is last year. So this is D sub 0. This is the last dividend that we know that we will use to solve for future dividends. Now if our required rate of return was 14%, what is the maximum price that you'd be willing to pay for this company's stock? So what we have is constant growth. When you have constant growth, your current price is equal to the next year's dividend divided by R minus G. They gave us the last dividend. So if you go back to the equation on solving for any dividend, to be able to solve for any dividend, you take the dividend that you know and you multiply it by 1 plus G to the number of compounding periods. We're trying to go from D sub 0 to D sub 1. So to solve for the dividend from year 1, we would take D0, multiply it by 1 plus G to the first power. We're just going to compound it 1 period. So D sub 1, the next year's dividend, is going to be $1.20 multiplied by 1 plus our growth rate, which is 6%, and we're going to compound it to the first period. So to figure out what the next year's dividend is, we just compound it 1 period, and our next year's dividend is $1.27. Now, if this equation part is confusing for you and you feel more comfortable using your financial calculator, feel free to do so. All you're doing is taking a present value of $1.20 and calculating a future value where you do not have a payment, your N is just 1 period, and you're compounding it at 6%. So it's the same thing that we've been doing since we introduced time value of money. This is just the algebraic way of solving what we have been previously doing on our financial calculators. So now to solve for the current price, I take that next year's dividend of $1.27, and I divide it by R, which is 0.14, the 14%, minus G, which is 0.06, and I get a current price that is equal to $15.88. So this is a constant growth equation or a constant growth scenario where the current price is equal to the next year's dividend divided by R minus G. That's the key part, is that you calculate the next year's dividend and you divide it by R minus G. Let's take a look at another example. Now we have a negative growth rate. I realize that that's there in the title, but we can also pick it out of the question details. So once again, we'll highlight some important parts. Managers at Remont Incorporated have decided to decrease the firm's annual dividend due to decreasing market share. The last annual dividend was $1.75. So last annual dividend would mean that this is D sub 0, our last dividend that we know. And all future dividends will decrease by 17% annually, what is a share of this stock worth today at a required return of 22%? So once again, we have a constant growth assumption. Our constant growth is actually just a negative growth rate. So once again, current price is equal to the next year's dividend divided by R minus G. They have given us D sub 0 at $1.75. They told us that our R, our required return, is 22%. And they have told us that our G, our constant growth rate, is a negative 17%. So we can see here from the givens that we have our R, we have our G. We need to calculate D sub 1. To calculate D sub 1, you're going to take D sub 0 and multiply it by 1 plus your growth rate to the first power. Let's just input our given information. D sub 0 is $1.75. We're going to multiply it by 1 plus, but here we have a negative growth rate, so we're actually subtracting 17%, raising it to the first power. And our next year's dividend then would be 1.4525. I'm going to keep this to 4 decimals since it is an intermediate calculation. We try not to round these values because they will have an impact on your overall final valuation if you do so. So now let's take that dividend for the next year and input it into our constant growth model. So the price at time period 0 is equal to the next year's dividend, 1.4525. And we divide it by R, which is 0.22, minus G, which is a negative 0.17. So as you can see there in our equation, instead of subtracting there, we actually will be adding our growth rate due to the minus a negative. And our current price, P sub 0, then would be equal to $3.72. So once again, that is a constant growth assumption where we are assuming a constant growth in our future dividends. In this case, the constant growth just happened to be negative. Now, what's nice about the constant growth model and something that you can do pretty easily then is you can use this constant growth model to now solve for future stock prices. So if you have a constant growth assumption, we can solve for the price at any point in time. What we've been doing is solving for P sub 0, the current price, but if we have a constant growth occurring for the infinite time frame, what would be the price at some point in the future if that growth remains constant? So our equation is pretty similar, except instead of P sub 0 and D sub 1, we realize that if I'm trying to solve for the price at any time t, could be year 5, year 6, year 7, you always just need the next year's dividend, t plus 1. So previously, we had P sub 0 equals D1 divided by R minus G. Notice that it's no different here with this equation. The only difference is whatever year you're solving for the price, you always need the next year's dividend. So that's why we started off by making sure that we were able to solve for any future dividend amount by just compounding the cash flow that we know, the appropriate number of periods. So here we have an example where they're interested in buying a share of stock of Fervent Incorporated, which is growing at a constant growth rate of 6%. Last year, the firm paid a dividend of $2.65. So once again, last year, this is D sub 0. Please keep in mind that your current price is the present value of all future dividends. If this cash flow is in the past, it would not go into our valuations. It's simply going to be used to figure out what is the upcoming cash flows, or what are the upcoming cash flows. So the required rate of return is 16%. That is our R. What is the current price of this stock? And then what would be the price of the stock in year 5? So before we get started, let's just write out what information we know. We know that the constant growth rate is 6%. Last year, the dividend was $2.65, so D sub 0 is $2.65, and our required rate of return is 16%. And the first thing they want us to know is what is the current price. So they want P sub 0. With the constant growth model, P sub 0 is equal to the next year's dividend divided by R minus G. So you can see here that we have D sub 0, the current dividend. We need the dividend for year 1. So once again, to solve for the dividend for year 1, we will take the current dividend, D sub 0, and multiply it by 1 plus G to the first power. So D sub 1 is going to be 265 multiplied by 1 plus 6% to the first power, and our dividend for 1 year from now, if it grows at a 6% growth rate, will end up being $2.81. Now we can take this $2.81 and input it into our constant growth equation, which now will allow us to solve for the current price. The current price is equal to the next year's dividend, $2.81, divided by R, which is 0.16, minus G, which is 0.06. So we will be dividing $2.81 by 0.1, And so our current price is equal to $28.10. So this is the current price based on this constant growth assumption. The next thing that they want us to know is, what is the price in year 5? So if we go back to our equation up here at the top, when we have constant growth, the price at any point in the future is still equal to the next year's dividend, so D sub 6, divided by R minus G. The R and the G do not fluctuate. We just need to figure out what is the 6 year's dividend. So if we go back to our equation for solving for the dividend for any time period, D sub 6 is going to be equal to D sub 0 multiplied by 1 plus G, but now we're going to compound it 6 periods, right? Another way I guess you could do this, or it might be trying to emphasize what this compounding process is you could also have the first year's dividend that we just solved for, but only compound it 5 periods to get to the 6th dividend. But what we'll do is just start with the cash flow that we know, and we'll just compound it 6 periods. This is just our simple time value of money compounding a single cash flow. So our dividend for year 6 is equal to the dividend that we know, 265, multiplied by 1 plus our growth rate, which is 6%, and we're going to compound it 6 periods. So the dividend for the 6th year, if it continues to grow at 6% year over year, that dividend in the 6th year will be equal to 3.7591. Once again, you can verify this with your financial calculators, and I am not rounding this since this is an intermediate calculation. And once again, if you are having troubles with the understanding of the equation here, remember, this is the same thing that we've been doing. This is the same thing that we've done in Chapter 5 where we found the future value of a single cash flow. Other way you could do this is say we have a present value of 265. What would be the future value if I compound it, where we don't have a payment, if I compound it 6 periods at an interest rate of 6%? Okay, so this is the same as what we've done. We're just using the algebraic equation to keep things consistent with the way that we can solve for the future value of any single cash flow. So now what we have here is this 6 years dividend. Let's plug it into our equation. And so the price in year 5 is equal to the next year's dividend. Sorry, let me erase that, clear it up a little bit. 3.7591 divided by R, which once again is 0.16 minus 0.06. Notice that I did not put it in parentheses in the last equation, but you do have to do that subtraction before you do the division. So let's go ahead and just be more clear from my previous example. So 3.7591 divided by 0.1 will give you a price of $37.59. So what we've been able to do is we've been able to take a cash flow that we know, a constant dividend, and make an assumption about what its growth will be moving forward, and we can solve for the price currently or for the price at some point in the future. Now, as you're looking at this, you might realize that there is a few things with your constant growth equation that must be true in order for you to use constant growth, and it relates to the relationship between your required return and your constant growth rate. So if the growth rate is greater than your required rate of return, then the constant growth model says that the value of the stock is negative. This is impossible. The furthest that a stock price can go down to is 0, but if you think back to our equation, it says that the price at any point in time is equal to the next year's dividend divided by R minus G. If your growth rate happens to be greater than your required rate of return, you can't use this model because it's going to give you a negative value. That is not possible. If your growth rate equals your required rate of return, the denominator is 0. You cannot divide by 0, so once again, you cannot use the constant growth model. Now, in these cases where your growth rate is greater than your required rate of return, the present value of the dividend actually gets bigger rather than smaller. Understanding our time value of money, the further in the future you receive a dollar, the less it's worth today. If the growth rate is greater than your discount rate, that the opposite would be true. It would be that the further in the future you receive the dollar, the more it's worth today, which we know is not does not make sense. And so this in this case, it implies that the firm is growing at a very fast rate and does so forever. So in the event that your growth rate is greater than your R, we cannot use the constant growth model, and what we will end up having to do is use our third assumption, which is supernormal growth. So what we'll do is this is just a brief introduction into our next model, the supernormal growth rate or the non-constant growth rate, which as soon as you see a growth rate greater than your required rate of return, you know that you cannot use the constant growth model assumption. So just continuing on, one more slide on constant growth and its conditions. So in order to use the constant growth model, which we said is the price is equal to the next year's dividend divided by R minus G, your dividend must be expected to grow at that constant growth rate, and it must be expected to do so forever. And if your price, if your stock price is based on the present value of future dividends, if your dividends are growing at a constant growth rate, then your stock price is also going to grow at a constant growth rate. Okay, so if your dividends are growing at a constant growth rate, then your stock price will also grow at that same growth rate due to the fact that your price is based on the present value of those future cash flows. Your expected dividend yield is constant. The expected dividend yield is the next year's dividend divided by the current price. So you will need to know this equation. Your dividend yield is the next year's dividend divided by the current price. This yield or return is constant throughout because your dividends are increasing at the same price or at the same rate as what your price is due to the first two assumptions here, or the first two criteria here on this slide. Also then, your expected capital gains yield is constant and is equal to your constant growth rate. Remember, capital gains is your increase or decrease if it's a capital loss in the value of your security. So if your security is growing at a constant growth rate G, then that is equal to your capital gains yield, your capital gains return. Your expected total return or your required return must be greater than your growth rate G. We discussed that on the previous slide. And then what we can do, and we'll talk about this more on the future slides when we solve for R, is that your R can be broken down into two different yields. Your expected dividend yield and your expected growth rate, which is your capital gains yield. So your expected total return is broken down to your dividend yield and your capital gains yield. And as I mentioned, we will do some more examples later on in today's discussion, solving for the required return or your total return. So the third assumption that we make on dividends or dividend growth is a non-constant, or sometimes referred to as supernormal growth. Sometimes early in their lives, successful firms will experience a supernormal growth, a supernormal rate of growth in their earnings. So as we mentioned previously, sometimes the growth rate will actually exceed the required rate of return, in which we realize that we will not be able to use the constant growth model. Now, it is not possible to sustain this growth rate more than the rate of inflation plus the long-term real growth rate. So we realize that this growth rate will eventually come down to where it is eventually lower than the required rate of return. And so what we will do when we are valuing shares of stock that have a supernormal early growth rate, or sometimes maybe it's just sporadic and it's a non-constant growth rate, is what we use is a combination of the general dividend valuation model and the constant growth model. So as I mentioned, to value these stocks, we will combine the first model that we discussed in this lecture, the general dividend valuation model, and then once these dividends exhibit constant growth, we will then use the constant growth model. The key here for these problems is to use a timeline. You need to identify where constant growth begins. Because what we will be doing is we will be finding the price when that constant growth occurs. So that's the first step, is to identify when does the constant growth actually begin. So I actually have that listed here in the PowerPoint. You need to identify when the constant growth starts. So this is just a visual of what we've kind of been doing previously. So we have our three growth assumptions here. The first and the middle line is the zero growth. That's the ones that we treat like a perpetuity. So in this example, the dividends would stay at $2. Then we did constant growth. We have a constant positive growth rate, and we have a constant negative growth rate. And what we're doing now is we're doing the top line here in this, and this is the non-constant or the supernormal growth. So what we will do is we will use the general dividend valuation model, for the first part of the dividend valuation, for the part where we have supernormal or non-constant growth, and then constant growth occurs right here at the end of the here at year 4. And so here what we will do is we will use the constant growth model. So the key is that we identify all the dividends during this non-constant growth. We'll discount them back to a present value. Then what we will do is we will find this price when the constant growth occurs, in this case P4, and then we will discount that back, and that will be the price of this non-constant growth model, or the non-constant growth scenario. Your equation. As I mentioned, find all the dividends during the non-constant growth. So this is your general dividend valuation model. So this is finding all the dividends during the non-constant growth, and then this is the price when the growth becomes constant. So all I did is kind of written an equation, what I verbally discussed on the previous slide. So let's take a look at an example. So this Reverop is a fast growth stock and expects to grow at a growth rate of 23% for the next 2 years. It then will settle into constant growth of 6%. The dividend to be paid 1 year from today, so they've actually given us D1 here. So they've given us the dividend 1 year from today. Simplifies our analysis a little bit. And that dividend will be equal to $4.25. If the required rate of return is 17%, what is the current price of this stock? So let's draw a timeline and showcase what we're actually doing here. So on our timeline, for the first 2 years, they are going to be growing at a growth rate of 23%. Then they will settle down into a constant growth rate of 6%. So as I mentioned, the first thing that you need to identify is when does the constant growth occur? The constant growth occurs at the end of this second year. So we'll have to find the price, if we look up at the equation, at time 2, and we will need to find the dividends, D1 and D2, during the non-constant growth. So what we will first be doing is we understand that the price in year 0 is going to be equal to the dividends during the non-constant growth, D1 and D2, plus the present value of the price when the growth becomes constant. So let's go ahead and calculate these values. They actually gave us D1 being equal to $4.25. So dividend from year 1 is equal to $4.25. We will need to find the second year's dividend, so the last dividend during the non-constant growth. And this is where we go back to our equation that says if I need to find the dividend for year 2 and I know the dividend for year 1, I'm just going to compound this 1 period at that supernormal growth rate. So notice with my calculations, I'm going to be using D1, since that's the cash flow that I know, as opposed to our previous problems where we had D sub 0. So in this case, I have the first year's dividend, and as you can see, I'm just taking this dividend from year 1 to year 2, so I'm only compounding it 1 period. So as I go through and input my input my inputs, my exponent here after my growth rate of 23% is going to just be a 1. So the dividend for year 2 here would end up being 5.2275. This is my dividend for year 2. And this is the first half of our equation, solving for or identifying all the dividends during the non-constant growth. Now what I need to do, and you can see it here in the last part of the equation, is find the price when the growth becomes constant. When I have constant growth at the end of the second year, my price is equal to, you have to think back to the constant growth equation. The constant growth equation says that the next year's, or that the price at this point in time is equal to the next year's dividend divided by R minus G. I know that R is 17%, and I know that my G with the constant growth is 6%, and so I just need to find D3. Here, since I have different growth rates going from 23% to 6%, I cannot just take the D1 that they provided and compound it 2 periods. I have to use D2, and going from 2 to 3, I'm going to compound it at the new growth rate of 6%, just 1 period. So the dividend for year 2 that I just calculated is 5.2275. I'm going to multiply it by 1 plus my new growth rate of 6%, and I'm going to compound it to the first period. So my third year dividend becomes 5.54115, and now I can solve for the price. So I can solve for the price by taking that third year's dividend of 5.54115 and dividing it by R, 0.17, minus G, 0.06, and I get a price here when the growth becomes constant of $50, and since it is an intermediate calculation, I'm going to keep it at 4 decimals. 3741, let's go ahead and write that on my timeline. So this price when the growth becomes constant is 50.3741. The current price times 0 is going to be the present value of these cash flows. So you can either plug it into your equation. D1 is $4.25. D2 is 5.2275. And then P sub T, which is P2, is 50.3741, and you discounted back the appropriate periods. Or, as you remember from our calculations in chapter 6, where you find the present value of multiple cash flows of different sizes, we can introduce the net present value function. So when I go to click on my CF function, this is where you might have to refresh yourself on how to find the present value of multiple cash flows. Our CF0 is the cash flow in time period 0. If we look at our timeline, we do not have a cash flow in time period 0. CO1 represents the cash flow that needs to be discounted back one period, so $4.25. F01 is how many times that cash flow occurs, just one. And so then with C02, even if you look at our equation up here at the top, you notice that the last dividend during the non-constant growth and the price when the growth becomes constant is going to be discounted back the same number of periods. So both of these cash flows here, the last dividend and the price, need to be discounted back 2 periods. So in our calculations, I'm going to take the last dividend and add it to the price when the growth becomes constant, and that is my second cash flow that needs to be discounted back the 2 periods. So 55.6016, and this is going to be discounted back 1 period. And these are the only cash flows that I need to discount back. So with non-constant growth, I'm going to emphasize this. With non-constant growth, you discount back the dividends during the non-constant growth. In this case, we have 2 of them. And then you also discount the price when the growth becomes constant. So then when I go to my NPV button and I input my discount rate, I input 17%. And I solve for the net present value. You get a net present value of $44.25. So this is how you solve for the value of a share of stock that has growth rates that are different early on, or supernormal early on, before it actually settles in to constant growth. So just looking at these equations here, I had to manually write in some of the functions, but the basic present value of all future dividends formulas says that you take every dividend and discount it back the appropriate number of periods. This is your general dividend valuation model. However, we can continue that and understand that the dividend growth model says that the price at any point t is equal to the next year's dividend divided by r minus g. And what we do is we combine these two models. So what we first do is we take all the dividends during the non-constant growth, this is your general dividend valuation model, plus the price when the growth becomes constant, understanding that this price is equal to all the dividends discounted back at the appropriate number of periods, growing at a constant growth rate. So if G, your constant growth rate, is constant after T equals 2, then the price at year 2 is equal to the next year's dividend divided by R minus G. So what this is trying to showcase is to understand that what we are doing is figuring out the present value of the dividends during the non-constant growth, and then this price represents the present value of all future dividends growing at that constant growth rate of G. So let's do a quick quiz, kind of recapping what we've done thus far. So a company, with these problems, the first thing that we need to understand is what type of growth assumptions being made. So you're going to ask yourself, first of all, do the dividends go on forever? If the dividends do not go on forever, then you need to be utilizing the general dividend valuation model. If they go on forever, we're going to make one of 3 assumptions. Is it zero growth? They stay the same. Constant growth, growing at some constant growth rate, or supernormal, where they have non-constant growth followed by some type of constant growth. So here the company just paid a $3 dividend. This $3 dividend just paid is D sub 0. Future dividends are expected to grow at a constant growth rate of 4%. If an investor has a required return of 12%, how much would you be willing to pay today? And then what is the expected price 2 years from today if we have this constant growth? So here we know that it is constant growth. So we are going to be using the P sub T equals the dividend for the next time period, dividend of T plus 1 divided by R minus G. Let's write down what they provided. So the company just paid a $3 dividend. That is D sub 0. That is a cash flow that has already occurred. It's not going to go into our valuation. It's simply going to be used to identify what the upcoming cash flows are. The constant growth rate is 4%, and our required rate of return is 12%. So the first one that they want us to do is, what is the stock price today? So P sub 0. To solve for the price at year 0, we need the next year's dividend, D sub 1, which we will divide by R minus G. They give us d sub 0, so to solve for d sub 1, we take d sub 0 and multiply it by 1 plus the growth rate, and we're going to compound it 1 period to go from 0 to 1. So we have 3 being compounded at 1 plus our growth rate of 4% to the first power. So our dividend here at the end, or our dividend for the next year will be $3.12. We can now solve for the current price, where P sub 0 is equal to the next year's dividend divided by R, 0.12, minus G, 0.04, and we get a current price that is equal to $39. Now the second part of the question wants us to know what is the expected price 2 years from today. 2 years from today we still have constant growth. So to find the price at year 2 with still having constant growth, we're going to be using our constant growth equation, which says we need the next year's dividend, D3, divided by R minus G. R and G have not changed, we just need to solve for D3. Two different ways. I could take D1, or I could take D0 and compound it at 1 plus G to the third power, or since I know that we have constant growth, I could essentially take D1 and compound it just 2 periods to go from 1 to 3. I'm going to use our initial equation just in case I made a mistake in that first step. So to solve for the dividend in year 3, it is D sub 0, which is 3, multiplied by 1 plus our constant growth rate of 4%, and we are now going to be compounding it 3 periods. So what is my dividend in the third year? My dividend in the third year is 3.3746, and once again, it's an intermediate calculation, so I'll leave it at 4 decimals. I can now solve for the price here in year 2 by taking the next year's dividend and dividing it by R minus G, and the current price, or the price in year 2 then, the expected price, would be $42.18. And now since the future is uncertain, these are the best things that we can do is make these assumptions. And so if the company continues to grow their dividends at a 4% growth rate, this is what we would expect their price to be based on our required return. Let's take a look at another example. Now the company just paid $1 dividend per share. Just paid means it's in the past, that is D sub 0. Future dividends are expected to grow at a rate of 20% for each of the next 3 years, and then a constant rate of 10% from that point on. So as you can see here, we have a non-constant growth assumption. So it's not constant from this point moving forward. It's actually growing for one rate for the first couple years before it settles on into constant growth. And then they want us to know what price would an investor be willing to pay 3 years from today if the required return is 14%, and then what would they be willing to pay today. So let's just draw a timeline. These are very beneficial in these non-constant growth equations, or scenarios I should say. So I always draw my timeline 1 period more than the constant, or 1 period more than the non-constant growth. So we have non-constant growth for the first 3 years where it's growing at 20%, and then it settles down into a constant growth rate of 10% from that point on. So moving forward from year 3 on, we have a constant growth rate of 10%. So the first thing that they want us to solve for is what is the price 3 years from today, and then also what is the price today. So we know from our previous problem that in order to find the price today is going to be the present value of the dividends during the non-constant growth plus the present value of the price when the growth becomes constant. So let's just go ahead and start off with solving for what the price is today, because we'll solve for the first part 3 years from today while we are doing so. So what are the cash flows that I will need to solve for the price today, P sub 0? Well, you're going to need the dividends during the non-constant growth, which would be D1, D2, and D3. And then you're going to need the price when the growth becomes constant. The growth becomes constant after year 3, so we are finding P3. So I've listed the inputs that we need to find, and what we'll do is we'll solve for these values and then transfer them over to our timeline and understand that our current price is the present value of those future cash flows. So let's write down what was provided. They said that the company just paid $1 dividend, so D sub 0 equals $1. The growth rate in the first couple of years is 20%, and our required rate of return is 14%. So let's first solve for the dividends during the non-constant growth. D1 is going to be equal to D0 multiplied by 1 plus G to the first power. So the dividend was $1. It's growing at a growth rate of 20%. I'm going to compound it 1 period. My dividend for year 1 then is $1.20. Let's take that and just fill it in on our timeline. $1.20 is that cash flow that we're going to be discounting back. Now we need to solve for D2. D2 can either be solved by using D0 and compounding it 2 periods, or you could take D1, $1.20, and compound it 1 period to get to that second year's dividend. I always go back to the beginning. Since I have the same growth rate, I could just take D sub 0 and compound it 2 periods at that 20% growth rate. So $1 multiplied by 1 plus 0.20 to the second power. So my dividend in year 2 is going to be $1.44. Once again, let's just transfer that to my timeline. And so the last dividend that I need to solve for is D3, the last dividend during the non-constant growth. So D3, once again, I could take D2 and just compound it 1 period, or I can go back to my initial given information of D0 and just compound it 3 periods since I have the same growth rate of 20% all along. So D0, once again, was $1. Now I'm multiplying it by 1 plus the growth rate of 20%, but I'm compounding it 3 periods. So my dividend in the third year will end up being $1.73. So I found the dividends during the non-constant growth. Now I need to find the price when the growth becomes constant. If the growth becomes constant after the third year, I'm solving for P3. When I have constant growth, P3 is equal to the next year's dividend, D4, divided by R minus G. So, as you can see, I know what R is and I know what G is. I'm going to have to solve for D4. Now, this is where it's different. Solving for D4, I can't go back to D0 like I've done previously because I have a different growth rate from years 1 through 3 and then going into the fourth year. So to solve for D4, I have to use the third year's growth rate. I'm going to compound it 1 period at that new growth rate of 10%. So I'm going to take D3, which is 1.73, and compound it at 1 plus the new growth rate of 10%. I'm only going to compound it 1 period. So when I solve for the fourth year's dividend, I get a fourth year dividend amount of $1.90. That is going to go into my equation here to solve for the price when the growth becomes constant. So I take $1.90 and I divide it by R minus G, where R is 14% and G is 10%, and I get a price when the growth becomes constant that is equal to $47.52. I'm going to transfer that over to my timeline. And as you can see, I now have all of the cash flows necessary to solve for the current price. And what we've just done here is actually solved for the first part. What is the price 3 years from today? 3 years today, when we have constant growth, the price is going to be equal to $47.52. Now let's solve for the current price. The current price is simply the present value of the dividends during the non-constant growth plus the present value of the price when the growth becomes constant. You could do each of these individually, take the $1.20 and discount it back 1 period at 14%, take the $1.44, discount it back 2 periods at 14%, and then both of these, $1.73 and $47.52, you add those two together, you get $49.25. Both of those would need to be discounted back 3 periods at 14%. Or you can use your financial calculator solving for the net present value. CF0 is 0. We do not have a cash flow already in time period 0. The key here is that this was just paid. The dollar dividend was just paid. So that is a cash flow in the past. Our price is the present value of all future cash flows. So CO1 is that first year's dividend of $1.20. F01 is 1. CO2 is $1.44. F02 is 1. C03 is that sum of the last dividend during the non-constant growth and the price when the growth becomes constant. So $49.25. F03 is 1. When I go to my NPV function and put in an I of 14%, and I solve for the net present value, the net present value is $35.40. So this is how you would value a share of stock that exhibits non-constant growth. Once again, verbally, what you were trying to solve for is what are all the dividends during the non-constant growth. In this case, we had 3. What is the price when the growth becomes constant, which in this case is P sub 3, and today's price is the present value of those future cash flows. So it might be wise now to take a quick break to kind of look over things and assess your understanding of our 4 different ways of solving for the stock price. The general dividend valuation model, or one of our 3 assumptions, 0 growth, constant growth, or non-constant. Look over some practice problems. And then when we continue to move forward, we'll start looking at the required rate of return and some of the different features and characteristics of stock. Okay, so the next thing that we will turn our discussion to is focusing on the required rate of return when we have constant growth. So if we have constant growth, we can look at the dividend growth model equation that says that the price in time 0 is equal to the next year's dividend, so D0 multiplied by 1 plus G divided by R minus G. This is just our constant growth model, or the dividend growth model, or the Gordon growth model. As I mentioned, these go by different names. If I rearrange and solve for this variable R, we can see that R can be broken down into the next year's dividend divided by the current price, which I mentioned briefly before, is our dividend yield, which can be thought of if I pay this price, what return or what yield do I get in the form of dividends for that next period? So the dividend yield plus the constant growth rate, and this constant growth rate is what is called our capital gains yield. So as I mentioned previously, if our dividends are growing by a constant growth, then our price is also going to grow by that same growth rate as well, so that G represents our capital gains yield, the increase or the return, the yield that we would receive in the form of the increase in the underlying security. So let's take a look at an example. A firm stock is selling for $10.50. This is P sub 0. They just paid, so D sub 0, a $1 dividend, and dividends are expected to grow at 5% per year, our constant growth rate. What is the required return? So as I mentioned on the previous slide, your R can be broken down into the dividend yield, D1 divided by P0, plus your capital gains yield. They gave us what the capital gains is. They also gave us P sub 0. We need to solve for D1. So as we've done previously, to solve for D1, we take the dividend that we know, D0, and to go from 0 to 1, we're just going to compound this one period at a constant growth rate of 5%. So if the last dividend was $1, we compound it one period at 5%, the next dividend will be $1.05. So now that I know what the next year's dividend is, I can go ahead and solve for the required rate of return. And so it's the next year's dividend, 1.05, divided by the current price, which is $10.50, plus our capital gains yield of 5%. And our required return here is 10% plus 5%, or 15%. So that is solving for the required return. You can see here, same scenario. What is the dividend yield? What's the capital gains yield? But just kind of breaking it down and understanding that the dividend yield, so the yield or the return that you receive in the form of dividends is 10%. And then the yield or the return that you receive in capital gains is 5%, so the increase in the value of our asset. So our total required return is 15%. So that is solving for the required return when you know the current price and you know what the dividends are, but this is used when you have constant growth. Now, what if we have companies that don't have dividends, or their dividends are sporadic and we cannot apply one of those growth assumptions? Well, what you can do is you can use a method called valuation using multiples. So for stocks that don't pay dividends or have this erratic dividend growth rate, so we cannot apply a 0, a constant, or a non-constant where they eventually settle off into constant, we can value them using the price to earnings ratio or the price to sales ratio. So the price at any point T is equal to some benchmark PE ratio, so it could be based on similar companies or your historic price to earnings ratio. Think back to chapter 3 when we talked about price divided by earnings per share, that's your PE ratio, and you would multiply it by the earnings per share for that particular time period T. So if you're using a PE ratio that is based on estimated future earnings, this is called a forward PE ratio, so you could also use this to solve for some price at some point in the future by using some forward PE ratio multiplied by the earnings per share for that particular, or for that targeted time frame. And then if a company does not have actual earnings, but they still have sales, there's a valuation called, or there's a variable, or a variation, sorry, of the price, or of this multiple valuation that says that your benchmark, instead of PE ratio, you use a price to sales ratio. Instead of earnings per share, you use sales per share. So the price to sales ratio can be especially useful when earnings are negative. So for those companies that are just starting off or have not yet been able to generate positive earnings, you can still get a valuation for their share of stock using multiples, but using the price to sales ratio instead of the price to earnings ratio. Let's take a look at an example. So Style Incorporated currently has an earnings per share of $3. So this is EPS times 0. And an earnings growth rate of 6%. If the benchmark PE ratio is 19, what do you believe is an appropriate price for the stock? And then what is the target share price 4 years from now? So the price at time period 0 using valuation using multiples is your benchmark PE ratio, which is 19, multiplied by your earnings per share for that particular period. Earnings per share in time period 0 is 3, so what we would get is a current price is $57. So if the stock price is lower, then you might consider this a good investment because your valuation based on using multiples values that stock at more than whatever that current market price is if the market price is lower than $57. Now, the next part then says what is the target share price 4 years from now? So you're using P4 is equal to that benchmark PE ratio, which is 19, multiplied by the earnings per share projection for 4 years from now. So what we have is earnings per share for time 0. We need to get the earnings per share from year 4, and hopefully this you realize that this is the same thing as what we've been doing with our dividends, right? We're going to compound the value that we know, which is the earnings per share for time period 0, just compound it 4 periods at whatever that growth rate was, which they said was 6%. So we take the current earnings per share, we're going to compound it 4 periods at 6%, and if it continues to grow at a 4% growth rate for their earnings, our earnings per share in year 4 would be 3.7874. So to solve for this projected price at year 4, this target price or forecasted price 4 years from now using multiples, we take our benchmark and we multiply it by the earnings per share for that target earnings per share, or that projected earnings per share 4 years from now. And what we would get is a per share price of $71.96. So this is valuation using multiples. This is another means of valuing a company's stock, particularly if they do not exhibit one of the 3 growth assumptions that we discussed previously, or if the company does not offer dividends at all. So, just a little wrap up of our summary of our stock valuation. This might be a wise slide to hold on to, so it has the different equations. Hopefully we have a good understanding of our general dividend valuation model, 0 growth, constant growth, non-constant, valuation using multiples, and then solving for your required rate of return. So now what we do is we turn our discussion to the different types of stock, primarily common stock versus preferred stock. We talk about the differences between those 2 different types of stock, and we also talk about how and where stocks are distributed, or traded, I should say. So what is common stock? Common stock is the most common type of equity security. There's no priority in bankruptcy proceedings, so it's equity without priority for dividends or in bankruptcy, whereas preferred stock has this preference in regards to dividends and bankruptcy. So it is a stock with dividend priority, so they get paid their dividends before common stock. Normally, it is a fixed dividend rate. That's why we treat it as a perpetuity, so a constant cash flow, equally spaced forever, and oftentimes without voting rights. So we'll talk about what voting rights means, but you don't get to have the voting rights on important events for the company. So like the board of directors, mergers, acquisitions, you don't have any say on those important matters. So first we talk about common stock. So as I mentioned, common stock does have voting rights. So the stockholders elect the directors, and then the directors hire the managers. So if you think back to Chapter 1, we have that agency problem, the separation between shareholders and management. So the shareholders elect the board of directors, and then the board of directors then hire the CEO, CFO. So there is this this separation between those owners, the shareholders, and the management. But the shareholders get to elect the directors. Usually it's 1 share, 1 vote. So if I have 40 shares of Apple, I get 40 votes. And then there's different types of voting. There is cumulative voting versus straight voting. The main thing that I'll focus on here with cumulative voting versus straight voting is just trying to focus on the generalized concept between the 2. So with cumulative voting, it is a procedure in which a shareholder may cast all votes for 1 member of the board of directors. And so the reason why they have cumulative voting is it permits minority shareholder participation. So let's say there are 4 directors being elected, and you have 2 shareholders. You have shareholder A that has 20 shares, and you have shareholder B that has 80 shares. Now with, let's say both shareholder A and shareholder B want to be a director. Now with cumulative voting, you will elect all the directors at once. So you have 4 directors, and if this individual shareholder A has 20, if shareholder A has 20 votes or 20 shares, then they would get 20 votes times 4 directors. They would have a total of 80 votes. And then shareholder B, if they have 80 shares electing 4 directors, they would have 320 votes. So there's no way that this shareholder B could distribute their 320 votes so that all 4 directors would have more than 80. 320 divided by 4 would give you 80. Shareholder A has a total of 80 votes, so if he put all of his votes towards himself, he's essentially guaranteeing him a spot. So what cumulative voting does is it allows minority shareholder participation. Now, it might be easier to think of this in contrast to straight voting. With straight voting, it's a procedure in which a shareholder may cast all votes for each member of the board of directors, and directors are elected one at a time. So if it was always shareholder A versus shareholder B with straight voting, they would elect one director at a time, and shareholder B would be able to choose all the directors. So with straight voting, it essentially phases out the minority participation. So as a minority shareholder, you do not have as much say with straight voting as opposed to cumulative voting. Now, oftentimes boards are staggered or classified. So with staggered elections, only a fraction of the directors are up for election at a particular time. And so basically, when you have these staggered elections, it makes it more difficult for a minority to elect a director than when there's cumulative voting, because there are still fewer directors to be elected at one time. So it's a kind of a mixture between cumulative and straight voting. It still provides some minority power, but it does not give them as much as cumulative voting, where they can really place all their directors towards one place all their votes towards one director and really try to get and really try to sway at least one of those director positions. Another thing with voting is you have proxy voting. So a proxy vote is a grant of authority by a shareholder, allowing another individual to vote his or her shares. So for example, I'm a shareholder of Apple and I'm unable to make the annual meeting and I'm not able to vote. What I can do is allow somebody else, I can grant someone else my proxy and they can vote on my behalf. So that is proxy voting. Other features of common stock is oftentimes there are classes, so different classes. Typically, they're created with unequal voting rights. So Class A versus Class B. So for example, let's say Class B stock could not be publicly traded where Class A is, but Class B would have more voting power. So for example, Class A is publicly traded, 1 share, 1 vote. Class B is not publicly traded, maybe it's 10 votes per share. And so what you could do is you could have these company insiders have the Class B shares so that they can have still more control over the company and its directives. Some other rights include the right to share proportionally in dividends paid. So if dividends are paid, you have the right to your proportional amount, but you are not guaranteed dividends. Additionally, you have the right to share proportionally in remaining assets during liquidation, although your priority is lowest. So behind creditors, your bondholders and other lenders, and then below preferred stockholders. And you also have the preemptive right. So what is preemptive right? Preemptive right allows you to maintain the same proportion of ownership in the firm. So let's say the company has 100 shares outstanding and they want to raise new funds in the form of equity. So what they're going to do is issue an additional 10 shares. Now this is obviously a simplified example, but if the company has 100 shares, let's say you own 10, so you have a 10% ownership interest, and they want to distribute or sell an additional 10, you would have a right to one of those 10 before it becomes available to the public so that you can maintain your same proportion of ownership within that company. So that's what a preemptive right is. It allows you to maintain your same percentage without being diluted when new shares are issued on these secondary or on these financial markets. Okay, dividend characteristics. So as I mentioned, firms are not required to pay dividends, so they are not a liability of the firm until they're actually declared by the board of directors. So one of the main differences between debt and equity is with debt, they have to make those interest payments. With equity, they do not have to make those dividend payments to shareholders. So as a result, a firm cannot go bankrupt for not declaring dividends. So you don't have any legal recourse if a firm is deciding to not issue dividends. Dividends and taxes. So how are these dividends taxed? So dividends are not tax deductible. So as a shareholder, you know that dividends are paid out of net income. So you are actually double taxed on this as an owner. So you're taxed at the corporate level and at the personal level. And these dividends are taxed as ordinary income for individuals. And it's kind of interesting. Corporations that own stock in other corporations are actually taxed differently. Oftentimes, they can actually exclude like 70% of the dividend amount and only pay taxes on the remaining 30%. Just one of these tax implications on dividends and the different types of ownership, whether it be individual ownership where you have the double taxation, but with corporations that own stock in other corporations, you may be able to actually not pay taxes on the entire amount of the dividends. So that's common stock, a general quick overview. This is the type of stock that you're probably most familiar with, purchasing on your on these different applications or with your financial advisor. But these are some basic characteristics of common stock. Moving on to preferred stock. So with preferred stock and dividends, these dividends must be paid before any dividends are paid to common stockholders. Again, they are not a liability of the firm. However, they can be deferred indefinitely and they are often cumulative. So if there are cumulative and there are missed preferred dividends, these missed dividends must be paid before any common dividends can be paid. So even in the event that they are deferred, then if they are deferred, then common stockholders must also defer dividends. And then if they are cumulative, the sum of the dividends need to be paid to the preferred shareholders before common stockholders can receive any dividends. They also have a stated value. So preferred shares have a stated liquidating value, usually $100 per share. And then as I mentioned when we discussed zero growth, the cash dividend then is described in terms of the dollars per share. So it's oftentimes it's some percentage, similar like a bond and its fixed coupon payment. The fixed dividend amount is something as some percentage of the par value. So additionally, preferred stock generally does not carry voting rights. And so the argument is that preferred stock actually has more characteristics making it more similar to debt than it is actually equity. So just like a bondholder, no voting rights. Just like a bondholder, equal cash flow. Oftentimes, preferred stock has a credit rating just like bonds. Oftentimes, or not often, sometimes it is convertible just like so it's convertible to common stock, just like a bond obligation. Oftentimes, preferred stock is callable. So there's a lot of similarities between preferred stock and debt, so your bonds. However, we know that it is classified as an equity account, but it does have a lot of the similar features of a debt obligation. So where are these stocks sold? So first of all, there are primary markets and secondary markets. So primary markets are the market in which new securities are originally sold to investors. So here you have your IPOs, your initial public offerings. There are also primary market transactions that are private, but these are the new securities being sold to investors. So these are securities that have not yet been available to investors. A secondary market is the market in which previously issued securities are traded among investors. So when Twitter went public and they issued new shares to the public, this was what is called a primary market transaction. So this was the initial offering of the securities. This is a primary market transaction. If I purchased these securities and then sold them to somebody else out in the market, that is a secondary market transaction. So which of these types of transactions actually impacts the cash balances for these companies? Primary market transactions are what impact the cash balances for the company. That's how they raise new funds to purchase these other assets. Secondary market transactions, although important and something that the firms keep an eye on, do not actually impact the company's financial standing. You also have dealer market versus broker market. A dealer is an agent who buys and sells securities from your own inventory. So think of a used car dealer. They buy a car from you, and then they turn around and sell it to someone else at a higher price. So there is a thing called a bid price versus an ask price. So the bid price is what they're willing to buy at. The ask price is what they're willing to sell at. So that is they earn their money on the difference. So they buy your car from you at the bid price, and then they turn around and sell it at the ask price. And a dealer buying and selling out of their own inventory makes their money on what is called the bid-ask spread. Then we have a broker market, which is an agent, or a broker is an agent who arranges security transactions among investors. So they bring buyers and sellers together, and they earn what is called a commission. Think of a real estate broker, but that is the difference between a dealer market and a broker market. Dealer buying and selling out of their own inventory. Brokers bringing buying and sellers together, earning a fee called a commission. So a couple different stock exchanges we're just going to discuss briefly. Two major stock exchanges here. The first is the New York Stock Exchange. This is the largest stock market in the world in terms of dollar volume of activity. So in terms of dollar volume of activity and total value of the shares listed. So typically with the New York Stock Exchange, they tend to have larger companies and more frequent trading. In April of 2007, they became the New York Stock Exchange Euronext, and then they were purchased by ICE in 2013. But they are the largest in the world in terms of dollar volume of activity and total value of shares listed. The members, as of 2006, a member is the owner of a trading license. So in order to trade on the New York Stock Exchange, you have to have a trading license. And so there are 1,366 trading licenses in 2006. It might be slightly different now, but you have to buy one of these trading licenses. And there are three different types of license holders. The first is what is called a designated market maker. So these are members who act as dealers in particular stocks. So each stock has their own designated market maker. It used to be known as a specialist. And what they will do is they will continually post updates on the bid prices and the ask prices of that particular security. Then you will have your floor brokers, who are members who execute customers' buy and sell orders. So these are your brokers bringing together the buyers and the sellers and executing these trades. And then you also have your supplemental liquidity providers, your SLPs. These are investment firms that are active participants in stocks assigned to them. And so basically their job is to buy or sell purely for their own accounts, and they are acting kind of as a dealer then with this license here. Now, how do they operate? So the operational goal of the New York Stock Exchange is to attract and process order flow, so the flow of customer orders to buy and sell securities. These designated market makers, they are assigned a broker and a dealer. Each stock has one assigned designated market maker, and at their post is this fixed place on the exchange where the designated market maker actually operates. The trading then takes place between the customer orders placed with the designated market makers and the crowd. And so the crowd is simply your floor brokers, your supplemental liquidity providers, and so forth. So as I mentioned, your crowd is your floor brokers and supplemental liquidity providers. And sometimes trades are actually executed in the crowd. So essentially what you have is you have all these different designated market maker posts. So all these different kind of areas where these stocks are being traded, and then these are called your stations. But then you have your designated market maker post, and this crowd of floor brokers and supplemental liquidity providers are going to and from each of these posts executing trades. Okay, so you may have more than one floor broker for an actively traded stock. If not, then the designated market maker will actually provide the liquidity necessary to make the trade. But this is essentially how the New York Stock Exchange operates. So they're attracting and processing order flow, and you have orders being placed with the floor brokers and also the supplemental liquidity providers buying and selling for their own accounts, and these designated market makers kind of acting as a dealer in the individual stocks being listed. Now, NASDAQ is the other major exchange. NASDAQ stands for the National Association of Security Dealers Automated Quotation Systems. It is a dealer market, In terms of the number of companies listed and on many days the number of shares traded, the NASDAQ is bigger than the New York Stock Exchange. However, they do have smaller companies, but they do have more listed. Firms used to start off on NASDAQ and then move to the New York Stock Exchange. But it is a computer-based quotation system, hence the National Association of Security Dealers Automated Quotation System. And there are 3 levels of information access. You have level 1, which is median quotes. So these are your quotes that you can find very easily over the internet, quotes just being the different transaction prices. Level 2, this is where you can see the highest bid prices and the lowest ask prices, but usually you have to pay for this fee. And level 3, these are for your dealers only. These are the level of information where you are actually updating quotes. So you can find level 1 quotes freely on the internet. Again, just prices of these different securities that are occurring on NASDAQ. Level 2 allows you to see the best prices, so the highest bid and the lowest ask, so the highest that a dealer is willing to pay and the lowest at what they're willing to sell. And then level 3 is for the actual dealers. But this is a dealer-based market. You're linked electronically, and you're able to make trades in that matter. A more recent development are electronic communications network. So these provide direct trading among investors. They were developed in the late 1990s, and these orders are transmitted to the NASDAQ, and you can actually observe live trading at batstrading.com. But really what it does is it just allows you to trade directly with other investors. And so it makes things it allows traders to be better linked through these electronic communication networks. Last up, just reading stock quotes. We can see a lot of different information here. You can see that we are looking at Costco here. Their current price is $160.63. You can see that they closed at $160.166. This is what they opened today. This is what a dealer is willing to pay. This is what they're willing to sell. Notice that they're selling at a little bit higher of a price, and so they make their difference on that spread. And these are the blocks at which they're willing to pay, or that they're willing to pay $160.33 for 100 shares, and they're willing to sell at $160.41 for 200 shares. You can see what the days range is on that particular stock, what their range has been in the past year. These are the number of shares being traded today. Their average volume per day is over 2 million shares being traded. Market capitalization is the total market capital of the company, so the number of shares outstanding the number of shares outstanding multiplied by the share price is what gives you your market capitalization. It is essentially the market value of the company. So when we say maximizing shareholders' wealth, it's essentially maximizing the market capitalization. That's what the market values this company at $70.56 billion. Beta is how volatile the stock is. You learn that in other courses. You have your price to earnings ratio, your earnings per share. You can see that they have their dividend yield, which is, remember, the next dividend divided by the current price. So they are giving you the yield there. But you can see a lot of different information applying some of the things that we've discussed here today, but just looking at this share of stock. So that concludes our discussion here on stock valuation. I know we've covered a lot. The key with the valuation is to understand that, first of all, if you cannot make an assumption about the dividends, you will just use the general dividend valuation model. Otherwise, one of the 3 assumptions would be the zero growth, constant growth, or non-constant growth. That would be our valuation. The other way to value shares would be using valuation using multiples. We can also solve for the required return when we have constant growth. And then we turned our discussion later on to the different features and characteristics of common stock versus preferred stock, and then how these different shares are traded. So good luck. Let me know if you have any questions about the material, and I will talk to you all soon. Thank you. Bye.